Okay, let's unpack this. Neogen Corporation, NEOG. This is a stock that's really been stuck, hasn't it? Caught in that whole integration mess after the big 3M food safety deal.
Absolutely. Integration hell, as you called it. Investors were definitely looking for, well, some sign of life, a credible path forward.
And then October 9th, pre-market, the new CEO Mike Nassif steps up for his first earnings call. This was Q1 fiscal 2026.
Yeah, and it felt less like a typical earnings call and more like a strategic reset announcement, trying to shock the system back into confidence.
A critical moment, for sure, because the integration really did hamper them for, several quarters now?
Oh, easily. Execution was the big problem.
Yeah.
So Nassif, he had to show right away that his turnaround plan was, more than just talk, real substance needed.
So that's our mission today, right? To figure out if these operational fixes, the pretty aggressive cost cutting, is it actually credible?
Exactly, because the market reaction, it was immediate and, frankly, huge.
The stock closed up 16.5% on the day. Trading volume doubled. That screams relief rally.
It absolutely does. But you have to ask, what was underneath that relief? What actually drove it?
Okay, let's look at the substance then, or maybe the potential substance.
Potential is the right word, because the current performance wasn't the driver. Let's hit the headline numbers that gave the market that bit of comfort.
Go for it.
All right. Total revenue, $209.2 million. And that was a clean beat over the consensus, which was sitting around $203.1 million.
Okay, a beat on revenue. What about earnings?
Adjusted EPS came in at 0.04 cents.
Yeah.
Pretty much right in line with what everyone expected. DAP EPS was higher, 717, but that got a boost from selling off the cleaners and disinfectants business.
Right, the C&D divestiture. But here's the catch, isn't it? For you listening, this is where the complexity comes in. That revenue beat sounds good,
but the underlying core growth, the sort of organic health of the business that's left, that was basically flat, only 0.3% year-over-year growth.
0.3%. And overall revenue is actually down 3.6%, mainly because of divestitures, like that C&D one.
Precisely. And that flat core growth, that's the real tension here, isn't it? The stock jumps over 16%.
On 0.3% core growth.
Yeah, it tells you everything. The rally wasn't about current sales momentum. It was purely about the promise of cost control, the new CEO, and future margins.
Which is why Nassif's plan, focusing so heavily on immediate, tangible cost actions, landed so well.
He didn't pull any punches either. He acknowledged upfront that performance was, quote, hampered by execution challenges.
Straightforward, at least. And he laid out 3 focus areas.
Yep. Commercial excellence, innovation, and a leaner cost structure. And you can guess which one the market grabbed onto immediately.
Leaner cost structure, I imagine, especially since he backed it up with action.
Big action. First, the headcount reduction.
Yeah.
Global. End of September.
How big we're talking?
Impacting about 10% of existing and planned positions. That's significant.
Wow, okay. And the savings target?
They're expecting that to generate around $20 million in annualized OPEX savings. Operating expenses, that is.
Okay, $20 million straight to the bottom line, potentially.
Yeah.
And the justification was basically right-sizing, wasn't it? Aligning costs with the actual revenue they're seeing now.
Exactly. They'd staffed up, assuming higher revenues post-merger that just didn't materialize. This cut is about reality.
And the second big action, that tackled the debt.
Yeah, the balance sheet. Another big worry for investors. They finalized the sale of that cleaners and disinfectants unit.
The C&D unit again?
You're right. And they immediately used the money, the net proceeds, to pay down $100 million in gross debt. Just bang, done in Q1.
That's tangible. Paying down $100 million. So where does that leave their total debt?
Brings gross debt down to $800 million. And paying that debt down also saves them about $6 million a year in interest costs.
Okay, so let's tally that. $20 million potential OPEX savings, $6 million in interest savings. Plus, they mentioned the genomics business sale is still moving forward.
Yep, progressing well was the phrase they used.
Right.
So yeah, it paints a picture of, getting serious about financial discipline.
But if we peel back the onion and look at the segments, the actual business lines, the picture gets a bit muddier, doesn't it?
Definitely mixed. Food safety, which is really their core, brought in $152.1 million, but core revenue there declined 1.7%.
A decline in food safety. What about animal safety?
That was the brighter spot. $57.1 million in revenue and solid core growth of 5.8%.
That food safety decline is concerning, though, especially when Nassif himself mentioned, FDA data showing rising food safety incidents, low consumer confidence.
Right. The market need seems to be growing, yet their core segment addressing it is shrinking slightly. That points directly to the operational hurdles.
Which brings us to margins. Gross margin still looks pretty squeezed, even with all the cost talk. Came in at 45.4%.
Yeah, 45.4%. And look, management points out that if you exclude integration costs, it's more like 49.5%. But 45.4% is the number hitting the financials right now.
And the reasons they gave for that pressure? They sound pretty deep-rooted, like real operational failure.
Well, they are, not high-level strategy stuff. It's factory floor supply chain problems.
Okay, let's break down the 3 big margin drags they called out. First one, sample collection. What's the issue there?
It's a mess, frankly. High production inefficiencies, too much material, high employee turnover. It all adds up to excessive production costs.
And how bad is it?
They were very clear. They are currently selling this product line at a loss.
Wow. Selling a core product at a loss, that's not sustainable.
Not at all. Every unit shipped is basically burning cash. It's an urgent problem. And management admitted fixing it, getting labor stable, cutting scrap, optimizing machines. It's a multi-quarter activity.
Hang on. A multi-quarter fix, but they just cut 10% of the workforce globally.
Uh-huh.
Isn't there a risk that cutting staff actually makes fixing a line suffering from high turnover and inefficiency harder? Could it slow things down?
That's the million-dollar execution risk, isn't it? The market seemed to gloss over that connection in the relief rally. It's a definite watch out.
Okay, what was the second big drag on margins?
The Petrifilm startup. Now, Petrifilm is their flagship product, high value, but they're building a new production line for it.
Right, the transfer.
Exactly. And that means they're incurring duplicate startup costs right now. They estimated about a $15 million cash impact just this year from that duplication.
And the timeline for finishing that transfer?
It's tracking towards completion in Q2 of next fiscal year. So still quite a ways off. It's a massive project.
That Petrifilm transfer, I mean, given the recent track record on manufacturing and supply chain issues, how confident can we really be they hit that Q2 next year target? It sounds complex.
It is complex. Their reassurance is that they have key engineers from the original 3M team involved. That helps. But yeah, the risk is definitely there.
Okay. And the third margin drag?
That one was a bit more technical. Tariff impacts. Basically, higher tariffs paid in previous quarters were sitting in inventory, and they flowed through to the cost of goods sold in Q1. Standard accounting lag.
Got it. Okay, let's quickly touch on Petrifilm demand. Because if they're spending all this money on a new line, the demand needs to be there. Core revenue for Petrifilm was down in Q1, right?
Mid-single digits, yeah. But management pushed back on that being a demand issue. They blamed distributor inventory shifts, a big distributor change in Asia, some normalization in the U.S. after prior stocking.
So they're saying the end user demand is still okay.
Their line was that U.S. sellout data, what distributors are actually selling through to end customers, remains solid. If that's true, it points back to supply chain and distribution execution, not a fundamental product problem.
Which ties into inventory management overall, another area they flagged.
Yep. They admitted they're carrying too much inventory, leading to write-offs. They need to get much better at S&OP.
S&OP, sales and operations planning.
Exactly. Matching what the factories make with what the market actually needs. Fixing S&OP is key to cutting those write-offs and, importantly, freeing up cash that's just tied up in excess inventory right now.
Okay, was there any good news operationally?
A small bright spot, maybe? The genomics business, the one they're planning to sell, actually returned to core growth, up 4%.
Oh, interesting. First time in a while, right?
First quarter of growth since fiscal 2023. Seems like their moves to get out of some less attractive parts of that market are paying off. Might make it easier to sell, too.
So pulling it all together for the investor context, the bull case now really hangs on execution, doesn't it?
Yeah.
And hitting that path to higher margins they promised.
Entirely. They reaffirmed the full-year guidance for fiscal 2026. Revenue $820 to $840 million, adjusted EBITDA $165 to $175 million.
But getting to that EBITDA range, that requires a pretty massive jump in margins from where they are now. Q1 adjusted EBITDA margin was what, 17%?
Exactly, 17.0%. The midpoint of their full-year guidance implies something closer to 20.5%. That's a big lift needed in Q2, Q3, and Q4.
How do they expect to get there?
Leverage. They expect strong follow-through on incremental margins, meaning as revenue grows even modestly and as those cost cuts kick in fully, a large chunk should drop to the bottom line.
So the $20 million in OpEx savings, fixing the money-losing sample collection line.
Yeah.
That's where the margin expansion comes from.
That's the plan, especially because the full run rate benefit of those $20 million cuts doesn't even really start hitting until the second half of the fiscal year, Q3 and Q4.
Okay, so the key things to watch, the catalysts. It's all operational. 1, Petrifilm transfer, is it staying on track?
Yep. 2, Sample collection, are they actually improving productivity fast enough to stop the bleeding there?
And 3, gross margin generally, can it consistently get back towards that, say, 50% level they need to support the EBITDA target?
Those are the big 3 operational tests, absolutely.
Okay, so Nassif laid out the plan, the market bought the promise, but the road ahead looks bumpy. Which brings us to our "This is not financial advice" segment. If you were pitching this, how do you play it, given the reward potential, but also this huge execution risk?
Right. So look, the market already reacted to the cost-cutting news, that 16.5% jump. That was the easy money, the relief trade. It's priced in.
But the real value creation, the margin expansion, depends on fixing those messy problems we just talked about. Sample collection, Petrifilm ramp.
Exactly. And those things carry a real risk of a stumble in Q2 or Q3. A delay, unexpected costs, things not improving as fast as hoped.
So the stock's priced for a degree of success, but the risk of near-term disappointment is still high.
That's the setup. So our pitch would be something like a structured turnaround play, use options, specifically a covered call.
Okay, break that down.
You go long the stock, you buy the shares because you believe in the long-term story, the new CEO, the demand for products like Petrifilm eventually winning out. But to protect yourself against that near-term volatility and execution risk, you simultaneously sell a call option against your shares, probably something near-term, slightly out of the money.
And selling that call option brings in cash immediately, right? Premium income.
Exactly. You get paid up front. That income acts as a buffer. If the stock chops around or dips in the next quarter because of an operational hiccup, that premium helps offset your potential loss.
So it hedges the near-term execution risk. What's the downside?
You cap your upside if the stock rips higher very quickly, faster than the option strike price you sold. But it's a trade-off. You're trading some potential explosive near-term gain for immediate income and downside protection against delays.
So it's a risk-mitigated way to bet on the turnaround, essentially. Betting it works eventually, but acknowledging it might take longer or be messier than the current stock price implies.
Precisely. It lets you stay invested for the long haul while managing the very real bumps expected in the next couple of quarters.
Okay, let's recap then. Market loves the cost cuts, loves the debt reduction, giving the new CEO a strong vote of confidence.
Big check mark there. But the core story now shifts entirely to fixing known difficult operational flaws. Inventory, sample collection, Petrifilm.
Which leaves us with a final, maybe provocative thought for you, the listener.
The CEO himself brought up the FDA data. Record food safety incidents, consumer confidence at a 13-year low. The need for what Neogen does is arguably accelerating.
Yet their core food safety revenue actually dipped 1.7% this quarter. That suggests they lost market share, likely due to those past supply problems.
So the question is, can this new team execute their back to basics, fix the factory's strategy fast enough to not only stop the bleeding, but actually reclaim share and capture these growing industry tailwinds?
Or does the intense focus required for these internal operational fixes mean they risk missing the window, spending quarters fixing the engine while the race accelerates around them?
That gap between the clear market need and their current ability to reliably meet it, that's where the real story, the ultimate value, or perhaps the remaining risk of this turnaround lies.
Something to definitely chew on. Thank you for joining us on this deep dive into the new narrative at Neog. We encourage you to weigh that execution risk carefully against what is undeniably a significant long-term market opportunity.